stock market is in a bubble. It's about to crash. At least that's what some of the experts are saying. Or some of you are probably thinking, oh, we're about to head to recession. Is this even a good time to buy stocks right now? So that's why I want to share history lessons of the stock market, show past performance, and help you realize it's not all doom and gloom. I also want to share the stocks that I'm buying in the most unloved sectors because I'm a bargain hunter. I also want to share one stock that I'm absolutely watching that pays monthly passive income, and I'll share my reasons why. Hello, it's Tracy here. I'm the host of Financial Nirvana Mama, a channel that's dedicated to helping you build multiple streams of income, earn your financial independence, and ultimately live your best life. Now, this video is all for entertainment purposes only. It's not financial advice, so please do your own due diligence. Now let's get back with the video. I'm gonna look at this big picture. Now I know there's a lot of data here, but I wanna just zone in on how interest rates affected the performance of the stock market. That's why I wanna look at the S&P 500, which is a good indicator of the health of the stock market. But let's talk about how expensive or how cheap the stock market is right now. So very, very long term, since the 1960s, the average PE ratio has been 15. Of course, I believe a lot of these companies in the S&P 500 are going to grow in income, in revenue, in sales, et cetera, et cetera. That's why the stock market grows. So if I believe some of these companies are going to grow and make a lot of dough, then I want to buy at today's price and assume that these companies are going to grow next year. So I'm going to use forward PE ratio. I'm not going to use today's PE ratio. I'm using forward PE ratio, which is projecting what the growth of these companies are going to be. So I just want to literally say, is it on sale relative to future earnings? So the indicator I'm going to focus on is forward PE. And as you can see in this chart, if we look at the S&P 500, excluding technology, the forward PE is actually 15.9. So we're getting super close to the average PE ratio since the 1960s. That means the S&P 500 is only pricey because, well, it's got a lot of technology stocks that are carrying it and it's making it a bit more expensive than usual. And that's why I've been focusing on a couple sectors in particular. Now, I just want to do a brief pause and share this amazing platform that I've been using. If you've been juggling multiple brokerage accounts, like Wealthsimple, Questrade, your bank, it's probably driving you nuts. It definitely has for me. But what if you could see it in one simple platform? Well, meet Passive, a simple tool letting you see and manage all your accounts, your TFSA, your RRSP, your RESP, all in one spot. You can invest and rebalance your portfolio with a click of a button and seamlessly manage between multiple accounts. And a bonus, if you are a Questrade user, you could put your investing on autopilot. Now, if you're worried about privacy issues, Passive never has access to your account info. You can feel safe about linking your accounts. Hit the link in the description below or in my pinned comment. Sign up to Passive for free and you're a Questrade user. Make sure to upgrade to get your premium features because it's free. Now let's look at it more macro view on this big picture, which I promised to share with you today. You look over the long term when inflation was at double digits, when interest rates were at double digits since the 1980s, the S&P 500, well, of course, would correct itself during those times because inflation was at double digits. So do you believe in the future? Do you think we have inflation at double digits or do you think it's slowing down? Because if you think it's slowing down, then we could have an opportunity right now. Because if the trend follows what it has in the past, we could be at the peak. And that means once interest rates start dropping, hold on for dear life because the stock market is going to go up like it has in the past. Now, if you zoomed out and looked at the stock market over the very long term, it doesn't matter if interest rates are double digits, inflation's at double digits, that COVID happened, that the financial crisis that happened, because there's been a lot more green than there has been red. And then generally the stock market has been going up for the long term, as long as you hold on to decades. Now, if you looked at compound annual returns, US stocks are at the top. They outperformed everything possible. Then it's international stocks, then a balanced portfolio, and near the bottom are bonds, of course, because bonds is for protection, just when the stock market goes crazy and goes overall. And another thing, if you just held onto stocks for 1 year, you could have a double digit, but if you hold it for decades and decades, that's when you start performing. So short term could be a lot of pain. The long term can be a lot of gain. Now, as promised, I want to talk about the stocks that I've been buying and investing in. The first one is Microsoft. Now, in my humble opinion, Microsoft is recession proof. And if you want to know all the details of why I think it's recession proof, you could check out this video here. Now, in terms of how expensive it is, well, I would say that it's not super expensive, nor is it dirt cheap. No way, Jose, is it dirt cheap. But relative to how it's growing year over year, how it's been performing, I would say that's on the average. So that's why I've been dollar cost averaging into Microsoft. And you look at the forward PE compared to past PE, it's about average, depending on the day you're looking at this video. The next two stocks I've been buying are in the beloved financial sector, which are banks. I've been buying Royal Bank and I've been buying TD Bank more heavily in the last 6 months. Now, I know some of you might be thinking,
no way, Jose, interest rates are rising. Mortgages are going to go into default. People are going to renew their mortgages in the next 3 years and interest rates are going to be high. And guess what? Banks are going to get killed.
That is definitely a potential scenario that could totally play out in the next 3 years. But in my humble opinion, I don't really care. The banks, I believe in the long run, they're one of the most conservative areas in Canada. We have such strict rules for getting a mortgage, and they're so proactive in getting you to pay. And guess what? Housing is an essential need. Many of us are willing to stop our car payments before we stop our mortgage payments. And if you're a dividend income investor like me, who's all about collecting passive income, bottom line, I am not worried about banks paying me dividends every single year. Their dividend payout ratio is super low. So that means they can afford to pay me income as long as they're well below 75%. And that's all I care about. So short term, definitely they can go get killed a bit more, just like did in 2020 during the COVID crash. And in the long run, banks always win with our money. And the next stock I've been buying is VFE. As I showed you, just looking at the forward P ratio, it's not that bad. It's almost at the average P ratio since the 1960s, which is why I've been dollar cost averaging buying VFE in my kids' RESP account, because they're going to have a lot of time in school and they'll need the money. Now, the next stock I am watching is in the unloved sector, real estate investment trusts. So with high interest rates, I always think of where can I take advantage of opportunities? So this is the reason why I'm watching Smart Centers, because Smart Centers has been getting killed like all REITs in a high interest rate environment. And now that Smart Centers is paying 8.67% in dividend income, it has caught my attention. Now, the only reason I'm taking a step back is I really want to watch its performance in the next investors' presentations, where I want to see, can it afford these payments? Because when I see 8.67%, sure, is very interesting. But I just want to know, how affordable is it in the long run? What gives me a bit of comfort is seeing that, well, the CEO still owns a big proportion of the company, which I absolutely love. And recently, it also made some purchases in August. So I actually do think Smart Center is very undervalued. But in the end of the day, I'm not caring about overall performance of Smart Centers. I care about how reliable is this dividend income. Because the worst thing is, the dividend gets cut, and that means the stock is going to drop. So I'll be watching this stock like a hawk. Now, if you want to learn how to make $1 million tax-free and make your kids rich, definitely want to watch this video. Anyways, I hope to see you in the next video. Bye.